As housing markets had one of its worst years on record, wealthy individuals, family offices, and closely held companies spent a combined $455 billion on commercial real estate. What do they know that we don't? This week, we're going to take a look at the housing market, what happened in 2022, what we're expecting in 2023. We're also going to find some different ways you can invest in this kind of market if that's something you'd like to do. And then finally, we're going to leave you with the influencers and what that is, why you should know about it, and what's happening there. My name is Trevor Miller from Cherry Hill Private Wealth. Hope you enjoy. The housing market around most of the globe saw reductions in value throughout 2022, and there's some real uncertainty of what's going to happen in 2023, and I'll dive into that in a minute. But if we take a look back, in December, the U.S. housing market slid for 11 straight months, and if my math is accurate, that was most of the year. In Canada, we saw similar results with drops in St. Catharines, Hamilton, London, Oshawa, and Windsor dropping between 25 and 30%, and Toronto saw a decrease of about 17%. Much of the drops correlated with the increases that were enjoyed leading into 2022. Throughout that pandemic, people were moving out of Toronto, so Toronto only saw about a 47% increase during that time, while Windsor saw gains of almost 100%. The other four saw increases ranging from 75% to 87%. Other Ontario cities like Ottawa, Sudbury, and Thunder Bay saw affordability holding up, but there was still a decline since the first quarter of 2019. Like most markets, buyers and sellers don't like unpredictability, and buying and selling a home is a major undertaking. For any of you that have done this before, you understand exactly what I mean by that. With lots of financial and emotional implications there, with higher borrowing costs, buyers are either being priced out of the market or just too nervous to make that purchase. In the US, the number of existing home sales plunged by almost 37% from January 2022 to January 2023. Canada had more immigration in 2022 than we've ever seen before, and the goal for the next decade are to continue with around 500,000 new immigrants per year. So, with this increase in population and prospective buyers and a very limited availability, why are we seeing such a pullback in actual prices? According to First American Financial Corporation, a 1% increase in mortgage rates from 6.4%, which they currently are in the US, to 7.4% would have the same effect as a 10% increase in home prices. With inflation still not entirely tamed, are we about to see a housing crash like we saw in 2008? Experts say that it's not likely. In 2008, home prices plunged by 33% in the US, and analysts polled by Reuters suggest that prices in the US will continue to decline by a modest 4.5% this year, which will bring the overall fall to about 10% from their highest peak. They're also expecting to see an easing of mortgage rates this year, which will help turn the tides in the latter part of 2023. In Canada, banks are not so sure. According to CIBC, 1 out of 5 mortgage holders are in a position where their monthly payments are not high enough to cover even the interest portion of their loans. The bank has allowed these borrowers to extend their amortization period and add unpaid interest to the original loans. This really exemplifies the stress that many borrowers are under with the increased rates. The Canadian banks have also recently announced that they have put aside more than $2.4 billion to cover potential losses. These provisions for credit loss, or PCLs, have increased from $373 million a year ago, which is a pretty significant increase. Lawrence Booth, who is a financial professor at U of T, said, currently, with the Bank of Canada pushing up short-term interest rates to slow the economy and bring down inflation, the expectation is for a recession in Q2 or Q3 of this year, which really just kind of goes back to why a lot of these banks have put all that money aside for defaults. There were signs of a recovery as homes in the GTA ticked higher in February, offering some relief to homeowners who have watched their values plummet over the past year. There were also more prospective buyers, and the average number of offers received per sold home has also increased. And this could really mean that prices are set to increase throughout the year, as selling prices of homes or condos rose about 5%, or about $57,000 in February over January's number. This, however, is a decline of about 1% if we seasonally adjust it. Regionally, the average house sold for 20% less in February than it did a year ago. So we just talked about the uncertainty surrounding the real estate markets. So why the heck would you want to invest in this market? And if you actually did decide to invest, how can you go about this in a way to maximize your returns and minimize your risk? The first and most common way to invest in real estate is in your principal residence. And yes, there has been a significant pullback over the past year, but you would also see that in most investments that you put your money into. In Canada, not only have the gains in the residential markets been one of the best asset classes that you could have owned over the past few decades, but for your primary residence, All capital gains are tax-free. If you have the capital, a good way to invest is purchasing a secondary property and renting it out. There are pluses and negatives to what and where you purchase, and an in-depth analysis would be needed before actually pulling the trigger. With residential long-term properties, you have the appreciation of the property along with the rental income. As we covered earlier, the maximum yearly increase in rent is 2.5%. So if expenses increase or you misprice off the bat, it could be a while before you're able to correct it. You also have to deal with being a landlord, and plumbing issues in the middle of the night and different things like this could really take away from your overall lifestyle experience. You can also stick with residential, but aim for more short-term properties. This would increase your potential earnings and allow you to increase rents if circumstances warrant it. There are many pitfalls with this, though. If renters are only there for a short term, they might not treat your property with a ton of respect, and you might have to pay for repairs or broken items. You'd also likely have a difficult time if you look back to 2020 to find renters when the government shut down any sort of travel. Finally, municipalities are constantly reevaluating how they treat short-term rentals like Airbnb, and you might find yourself on the wrong side of a legislative change. Commercial real estate is also a great option. It comes with significant benefits such as higher returns than residential, qualified tenants that are more likely to follow the rules, and longer lease terms. For a 2,200 square foot property in Toronto, you could potentially be seeing rents of over $80,000 per year. There is, however, an exorbitant upfront cost to commercial real estate, and property management could be a challenge. If you're not for the management, you don't have the capital, nor the know-how to purchase and maintain the rental, you can look at REITs, which are real estate investment trusts. There are several different REITs that are available in Canada, include large portfolios of properties, including commercial, apartments, hospitals, shopping centers, and even residential. You can find both mutual fund and ETF REITs, and both offer various benefits and risks. Both can be found at most of your institutions that you would typically work with. Another option is to get into the lending side of real estate. Private mortgages have become more commonplace over the past number of years, as regulations have really forced the majority of lenders to tighten their lending criteria. But why would someone look for a private mortgage? There could be several reasons, but some of the most common are that they didn't qualify due to either a shorter credit history in Canada, or many business owners don't show as much income as they actually earn. You can do this as either an individual or as a pooled investment. A couple of my favorite real estate investment strategies are on the private real estate and private mortgage side. Private real estate has done very well, and an investment like the Forsyth private real estate pool has had steady returns even throughout 2022, where it had a positive gains of about 8.8% compared to the MSCI EMU real estate industry group, which saw losses of almost 17%. The Rockridge private debt pool, which encompasses private mortgages, also saw positive returns in 2022 at 6.27%. The more traditional income fund, the Bloomberg US Aggregate, saw losses of over 13% over that same period. However you decide to invest in real estate, it's a really great way to diversify your portfolio and take advantage of a typically good asset class. Though many people pretend to be above it, almost everyone who has ever used the internet has been influenced by it. TikTok, Instagram, Twitter, Twitch, Facebook, YouTube, and even websites like Wired are filled with people telling you what to buy, why you should buy it, and why you should buy it now. In this oversaturated, ad-filled environment, it was inevitable that many people would get burnt. Enter de-influencing, a trend that has taken over TikTok since about January. While influencers tell you why you need a product, de-influencers tell you the opposite. The same way there was a backlash of photoshopped ads in magazines or the Facetune selfies, people are just burnt out. Constantly being sold to is tiring, and being told everything is a miracle is exhausting. A few years ago, TikTok felt so authentic because it wasn't taken so serious. Brands weren't investing heavily into creators. It was just a fun space where there wasn't pressure. Now the pressure has really hit a boiling point. In November 2022, TikTok launched its TikTok Shop in the US. That's a fun thing to say, allowing users to make purchases directly on the app without being sent to a third-party realtor. Creators earn a commission by linking the shop products to their videos, so naturally, must-have products are now all over the app. A 26-year-old marketing consultant from Dallas who created a popular de-influencing video in late January has now shot from about 30 followers to 123 followers by making regular de-influencing clips. There's a lot of stuff that she's purchased that she says is just total crap, so she thought she would share it. She really wanted to help people save some money because she's a penny pincher herself, so she started posting de-influencing videos, and by a few days later, she had packages at her door. She posted her first de-influencing video on a Wednesday, and then by Monday morning, she had 2 packs at her door. So, she's not even sure how they found her. But this de-influencing has actually been kind of a way of influencing in itself, with brands trying to influence the de-influencers. Just a very complicated situation here happening over at TikTok. It's possible this entire trend is just a flash in the pan, but even if the hashtag de-influencing dies, I believe there's really an appetite for authenticity and hilarious, brutal honesty, and I think that will remain in this world over the next little while. So spring is officially here. Hopefully you get the garage and basement cleaned out over the next couple of weeks before I see you again. If you like what you saw, remember to subscribe. If you want to hear a podcast, check out our podcast hosted by Aaron. If you'd rather read it, go check out the blog. Follow us on Facebook, Instagram, LinkedIn, all of that, and we'll see you again in a couple of weeks. Talk to you soon. Bye.